Welcome, dear traders. Given a decline in the three benchmark indexes, investors are revising their positions amid the Fed's less aggressive rhetoric. Wall Street started August on a pessimistic note. US stocks snapped a three-day winning streak. Asian stock markets are in the red today as well. Main FX currencies are also down. Which factors are now impacting the market sentiment? Watch our video review and find out. Investor sentiment turned to sour after the release of the US GDP data, which confirmed a stronger than expected slowdown in economic activity. PMI Manufacturing data was also disappointing. Such a drop could force the Fed to soften its hawkish stance. Fed Chairman Jerome Powell also admitted such a possibility in his speech last week. On the weekend, the president of the Minneapolis Fed, Kashkari, confirmed that the regulator is committed by bringing inflation down. Several Fed members are also expected to deliver speeches this week. Evans and James Bullard are going to make speeches on a Tuesday and Loretta Mester on a Tuesday and Thursday. Weak manufacturing data revealed by other large economies intensified fears of a possible global recession. Apart from that, investors are rather cautious because of other macroeconomic factors. China added pessimism to Asian markets. Traders are getting rid of risk assets due to a decline in China's manufacturing sector in July and the country's property crisis. Tensions in the markets are also escalating as speakers of the U.S. House of Representatives, Nancy Pelosi, will soon visit Taiwan. China said that a visit by the House Speaker would be gross interference in the country's internal affairs. For this reason, China warned it would take strong and resolute measures to safeguard its sovereignty and territorial integrity if the United States continues to interfere. This week, traders are looking forward to the release of the non-farm payrolls report scheduled for Friday. Analysts expect a modest rise. If so, the likelihood of a less hawkish stance will increase. Dovish rhetoric and the lack of strong economic reports are pushing the US dollar down. The US dollar index has jumped by about 10% over the year. It appears its days of glory have passed and it will soon move away from its highs. Today, the US dollar index dropped to 105.43, a low of July 5 versus its main rivals. Shortly after, it rebounded to 105.57. During the Asian session, it was consolidating in the range of 105.05 and 105.70. The US dollar is also declining against the yen now. Over the past four sessions, the greenback has already lost 4%. The dollar-yen pair touched 130.59, a low of July 6. The yen grew higher amid China's downbeat economic data and concerns about a possible visit of Pelosi to Taiwan. So the yen as a safe haven currency climbed. On the top of that, it gained momentum amid a decrease in the yield curve between the United States and Japan and fears of a recession. The yen is also up thanks to falling commodity prices, as Japan is a net importer of crude oil and petroleum products. On Tuesday, the yen slightly lost steam, slipping to 130.95. Meanwhile, the US dollar has entered a consolidation phase. However, the pairs are still moving in the downward channel of 130.38 and 131.73. At the same time, analysts believe the yen could become extremely vulnerable if it drops below 131 on its way to the psychologically important level of 130. Today, the Reserve Bank of Australia announced a 50 basis point rate hike following similar rate increases by 50 basis points in July and 25 basis points in May. As a result, the cash rate in Australia reached 1.85%, the highest level since April 2016. The Reserve Bank of Australia stated that further monetary tightening is also possible. The size and the timing will be determined by fresh economic reports. The Aussie rose today to 0.7040 following the Reserve Bank of Australia's rate decision. However, the Aussie retreated a bit later as the Reserve Bank of Australia may soften its hawkish stance if fresh macro stats are weak. The regulator pays great attention to the Consumer Price Index, which is published in the country once a quarter. The next report is due at the end of October. It means that at the next two meetings, the Reserve Bank of Australia may abandon aggressive tightening and not change anything at all. So, in the Asian session, the AUD-USD pair dropped to 0.6919. It may slide even lower amid China's economic woes and falling oil prices. The pair was moving in a bearish zone of 0.6917 and 0.7034. Subscribe to our channel and keep your finger on the pulse with us. Feel free to leave your comments down below and see you soon.